New listings are up, pending sales are down, and that's leading to a shift in the San Diego real estate market. We're going to break it all down for you right now.
Let's check out what's happened over the past few weeks, and then we'll zoom out to look at long-term trends. All right, here's a chart of what's happened recently from March to April.
Yes, our month-to-month overview. Looking at March to April, we've had a 6.5% increase in new listings, a 6.5% decrease in pending sales, and that's led to higher inventory levels, which I'll talk about in a little bit. Closed sales are actually up 19% from March to April, and that's a bit of a lagging indicator because these March closings are February pendings and April closings are March's pendings. Market time down a couple days, and median price relatively flat, only increasing 0.5% from March to April.
All right, are we ready to talk about long-term trends?
Let's talk about it.
Okay. All right, here are some charts showing what's happened with new listings over the past several years.
Yes, so looking at this handy little bar graph here, 2023, 24, 25, we can see there was a really sharp jump between 23 and 24 for new listings in April. And April, of course, the beginning of spring when we expect to see new listings. More listings, 5.3% more listings this April than last. However, when you look at this year-to-date number, you can see there have been quite a few more new listings this year than last year and the year before that. And this is, of course, detached homes, similar trend in attached housing. However, these numbers of new listings are nothing like they used to be before the pandemic.
We've broken the seasonal pattern that we had established for several years. Now over the past couple of years, it's definitely condensed.
Yes, but new listings are definitely popping up bigger in 2025 than they did in 2024 and certainly 23. And so we'll move on and talk about closed sales.
Yes. All right, here we go with closed sales.
Yes, so again, with the 3-year chart here, more closed sales in 24 than there were in 23 and more in 25 than there were in 24. Although year to date, very, very flat. We had this. So, I mean, this is showing you that buyer demand has really been flat, the same over the last 3 years. And with all of these new listings popping up and this staying the same, that's going to create more inventory, and it already has. And then you can see here increase in closed sales from the beginning of this year to now.
We usually have that seasonal upswing in the spring, and it seems like it's still happening. So we'll see which way it moves next.
Yes, and like I said, it's been the same for the last 3 years. Although again, just looking historically, there used to be prior to 2020 or so, there were just a lot more closed sales per year than there have been more recently.
All right, well, we've had a lot of different dynamics going on in the market affecting median prices. So let's see what they're doing right now.
All right, so median sale price is up year to date, just a bit over last year to date. So not a big, huge increase there. And then it's actually down from last April. So,
and again, we're looking at detached numbers here, but they're similar.
Similar for attached. You know, you're down 0.7% for them, and down 1.4% median price for detached homes, and then just barely increasing over 2024's year-to-date number. When you look at the long chart on median price, it has been going up for a very long time. Although for the last 3 years, we've had these late second quarter, third quarter, fourth quarter declines in median price as inventory has risen. And this year inventory is rising more. So I really would expect to see a similar pattern in 2025 with decreasing median price between now and the end of the year. Unless that's just what I was going to say. We're going to talk about interest rates next, right? Okay, let's move on to that slide. Yes, let's do that.
All right, here are this week's Freddie Mac mortgage rates. Average rate 30-year fixed 6.76, which is looking pretty flat. And everybody's looking at the Fed. Are they going to raise? Are they going to lower rates? Is that going to help us out? Well, They met and they kept rates flat, but that's really kind of not the end of the story for mortgage rates. People think the Fed directly sets mortgage rates, or some people, and it's really more complicated than that.
Yes.
Mortgage interest rates are tied more closely to 10-year Treasury yields, which is a completely different animal, although it is also related to the federal funds rate, which is set by the Federal Reserve Committee.
Yeah, and those 10-year Treasury yields are far more what drives mortgage interest rates than the federal funds rate, which is what the Fed meets and adjusts based on economic numbers and inflation, et cetera.
Well, let's have some fun and pull up a long chart of, first of all, I'm going to switch this to all time. So let's look at all time mortgage rates,
Yes.
which goes back to, looks like goes back to 1971 here.
That's pretty far back.
April 2nd, Friday, 1971, 30-year fixed, 7.33.
Okay.
Okay, so I'm going to switch my screens around a little bit here, which is going to take a second, but we're going to also set up the 10-year Treasury yield charts. So just a second. All right, here we go. So we've got mortgage rates over here and 10-year Treasury yields over here. These are going back to looks like 1980, so kind of a similar time frame.
Yes.
And you can here. I know you like charts and graphs. I do too, but you can check out these charts and graphs.
Yes, I do like charts and graphs. And if we look at a similar time frame in 1981, for instance, for 10-year Treasury, in 81, it looks like the yield was around 15.82%. And a similar time period here for mortgage rates in 1981, rates were at 18.39%. And then over time, as Treasury yields go down, mortgage rates go down. So,
and the numbers are a little different, but the point is the shape of the graph is very,
yes,
very similar.
Yeah, there's a spread between the mortgage rate and the Treasury yield, but when 10-year Treasuries go down, mortgage rates go down.
I guess this was a long way of saying if you're looking at mortgage interest rates to see what's going on, don't just look at the federal funds rate, but look at the 10-year Treasury yield.
Yes.
And you had some more notes on that as well.
Well, the reason that rates jumped in 2022 is because the Fed stopped buying treasuries. From 08 to 22, there were several periods where the Fed was buying not just a few treasuries, they were buying billions and billions, hundreds of billions of dollars worth of treasuries. And they stopped doing that in 2022 because of course, when the Fed is forcing rates artificially low, it has other ripple effects in the economy, and they're trying to manage the overall economy for the benefit of.
That's about right here, where we see the
yes,
yields going up.
The Feds stopped buying the treasuries, and when they're buying up a bunch of treasuries, the yield is low, and when they're not, the yield goes up. Therefore,
I'll give you the mouse back so you can
mortgage rates go up. And then another thing the Fed does, in addition to buying treasuries, is shifting their balance sheet towards mortgage-backed securities, which can also lower the rates. Now, I mean, a lot of people recently started talking about, the Fed bought $34.8 billion in treasuries. It means they're starting this quantitative easing again. $34.8 billion is nothing compared to what the Fed was buying through 08 through 22. I'm talking, I mean, there were several periods of what this called quantitative easing. And, in the first quantitative easing period, the Fed bought close to $1 trillion in treasuries. And then right around COVID time, they were buying $45 billion a month in mortgage-backed securities and treasuries. So that's why we had these low interest rates, and it was keeping sales going, but it makes prices go higher. And home prices aren't necessarily calculated in inflation, right? Rent is, but not the price of a home.
Yeah, that's true.
Right. So as the Fed was keeping rates low, home prices are going crazy. So, they have this delicate balance.
Just a side note, but it's kind of wonky the way they calculate rents too. Basically, they just call people and ask them, what are you renting your house for?
Yeah,
this is a total bird walking aside note, but I kind of have some, questions about how they calculate that.
Yeah, the way inflation is calculated is a little screwy, in my opinion, as well.
Anyway, I think we're getting a little farther off topic.
Well, we are, but it's germane to the overall discussion of what's happening in real estate. And, as we move forward here, the Fed has definitely got some decisions to make. And it's a private entity. The president appoints the chairperson of the Fed, but it's not a federal entity. It's a private bank that exists to sort of bind the banking system together, because before we had the Fed, there were wild fluctuations in the economy, and this was designed to smooth those out, among other things.
All right. Well,
All right, so
that was a little more in-depth on quantitative easing and federal funds and
Well,
stuff that I was planning to get into. But
Well, we could take a deep dive into this stuff, and
well.
you could argue all day about what's good, what's bad. Of course, as somebody who wants to see lower interest rates, I'm like, come on, start buying treasuries again. But I know that's not necessarily the answer.
Well, if you're still with us, let us know in the comments, how do you feel about quantitative easing?
Yes.
Okay. Maybe we should save something for next time.
We'll save it for next time. Maybe we'll make a whole series of videos about quantitative easing. I don't know. It's fascinating to me, but somewhat dry.
Yes. All right, everybody. Thanks for joining us. If you like this video, please share, like, subscribe, comment, tell all your friends. We'll keep looking out for you, and we'll see you next time.
See you later.